Good morning. My name's Paul Nicol, Managing Partner at GFM Wealth Advisory. A very warm welcome to our GFM clients and our guests this morning for our webinar. It's my pleasure this morning to present to our clients and guests an update on three of our favourite listed investment companies: Australian Foundation Investment Company, Mirrabooka and Djerriwarrh. These listed investment companies are not only very well known amongst our client base as investments that are held, but are broadly very well known and very well respected in investment circles. Joining us this morning on the webinar, we have Mark Freeman. Mark is the Chief Executive Officer and Managing Director of Australian Foundation, Mirrabooka and Djerriwarrh. Good morning, Mark.
Morning.
We also have David Grace. David's the Portfolio Manager and he's chatting to us about Australian Foundation Investment Company. Good morning, David.
Morning, Paul.
We have Kieran Kennedy. Kieran's a Portfolio Manager and he's going to chat to us about Mirrabooka. Good morning, Kieran.
Good morning, Paul. Good morning, everyone.
Great. And finally, we've got Brett McNeil. Brett McNeil is also a Portfolio Manager and he's going to be chatting to us about Djerriwarrh. Good morning, Brett.
Hi, Paul. Good morning, everyone.
Gents, thanks for your time this morning. Now, before we get underway, we have the obligatory disclaimer, and that is that this morning's webinar is general in nature. There is no information nor advice that is being provided in this morning's webinar that in any way is specific to your personal circumstances. By all means, if you have any further questions after this morning's webinar, please feel free to get in contact with our office and to speak with one of our advisors. So, Mark, let me get underway with you first and foremost. Again, thank you for joining us this morning. Could I ask you to give us a background first and foremost on Australian Foundation Investment Company, Mirrabooka and Djerriwarrh, please?
Yeah, sure. So thanks, Paul. So obviously, as a group, our heritage goes back over 90 years to the start of Australian Foundation, or AFIC as we call it. So there's a very long history of investing in markets. And starting with AFIC, this fund was set up really as a service to the JB clients as they were at the time. And it was never meant to be, I guess, a money winner for the firm. It was really a service, and that culture's continued right to this very day. So we've actually got 4 investment companies that deal with Australian equities, the fourth one being AMSA, which is our high conviction fund, and we've got a slide on that at the end. But the shareholders own the company, so there is no external fund manager running these funds. We are employees of the companies, and the costs to run the business get allocated to the 4 LICs, so there's no additional fees on top of that. I said there's no fee leakage, there's no performance fees. It's simply cost recovery, and as a result, the cost to be in the funds, or we call it the MER, management expense ratio, is very low compared to other managed products in the business. As we always say, the shareholders own the business, we don't. So if you look across the slide here, AFIC's being the biggest. It's over $9 billion now. It's broad-based exposure to Australian and New Zealand equities. We are long-term investors. We want to be in companies and enjoy the compounding impact of great performing companies. We're not a trader of stock prices. We want to be investor in the companies. And I guess a term we often use is we want to get their shareholders' money close to great assets and great people, and that's part of a process which I'll come to shortly. So you can see AFIC there with MER of 0.14% with no performance fees. We understand total returns, but we also understand the importance of consistent dividend and income, and Dave will talk about that shortly. Djerri's got a bit of a bias towards income, so we're trying to generate income streams that are typically 1 to 1.5% higher than what you get in the market, but still try and produce a total return that is around the index. So we find a lot of investors in Djerri, as we call it, are probably in super funds where you can get the full benefit from franking credits. So it spins off a lot of franked dividends. So particularly funds that are in that pension stage, it's a very valuable product for those structures. Mirrabooka focuses on small to mid-cap stocks. So I guess theoretically, Now, in this area, the market can be a bit more volatile, but then you sort of expect better returns, and that's what Mirrabooka has produced over the long term. MER 0.59, but again, no performance fees. And it's also, Mirrabooka has thrown out a lot of franked dividends as well. So it's given you great capital growth as well as great dividends. And as I said, AMCIL's the high conviction fund. That's the fund I run. We're trying to keep ourselves to a smaller number of stocks and have a mix between large, mid and small companies, and the MER 0.66% at the moment. So there's a bit of background on the 4 funds.
Terrific, Mark. And would you mind explaining to our clients and guests the general investment approach of these 4 listed investment companies?
Sure. So if we sort of jump to the next slide, we see ourselves, I guess a couple of the sayings that I was trained with, and I've been involved with these funds for it's coming up to 30 years now, and I was sort of well taught by the chairs of the companies before that. When I first started, stick with the quality is what we talk about, and buy when we see value. So we're trying to hunt for value within quality companies. And so the question would be, well, what do you mean by a quality company? And we've thrown some bullet points up here. So we like companies that have a leadership position or a developing one in the markets in which they operate. Companies that have unique assets that are hard to replicate. We like our companies to have conservative balance sheets. It's amazing how many times debt gets companies into trouble. We monitor external risk factors, or we call it outside influences on business. So we're wary of companies that have too much outside influence. We prefer companies with more consistent earning streams. The people are critical. So we want to make sure the people running the companies, and we talked about effective, passionate management teams. And one of the things we often talk about is ownership alignment. And we've certainly got a soft spot for what we call owner-driver companies. So businesses where the founders or founder-led companies have come through and they've proven themselves to be great at running a business. We like those companies a lot. And then they're all the factors around the business, but ultimately we still want our companies to be able to grow, because ultimately when you look out over the long term, share prices ultimately follow profits. And you need to be in companies that you think can grow their profits over the long term to see growing dividends and growing share prices. So businesses that don't grow profits, you'll look back in 10 years' time and say, gee, that share price has gone nowhere. And the answer will be because they haven't grown profits. And in between profit growth, stocks can trade at higher PEs and low PEs, but that creates the volatility. But ultimately, it's the profit. And so the frameworks that we've set up, it's about giving us the best opportunity to find companies that will grow their profits over the long term. And that's where our frameworks sit. Once we find great companies, we want to be a holder of those. So on the right, I've sort of really touched on those. So these factors drive sustainable competitive advantage, which leads to higher return on capital, which gives companies a great opportunity to invest, to grow, capture market share, be a part of growing markets, and therefore deliver great shareholder value creation and therefore dividend growth. And as I said, that sets us up for the sort of companies we want to buy. And then the next step is buy when we see value. And we talk about sort of 2 buckets there, I guess, more established companies. It's amazing how many times in a year a really good company gives you an opportunity, a business that goes out of favor, there's a bit of bad news. We always look to that to buy. And then you want to be picking up the emerging winners. And that's all about getting into a story early that has the characteristics. So it's about hunting for businesses that have the right characteristics rather than trying to sort of forecast the future. And that's a big part of what we do. So there's a bit of background on how we utilize, I guess, some of the tools we have to look for stocks.
Thanks, Mark. That's a terrific explanation. So, David, I'm going to hand over to you. We're now going to focus on Australian Foundation Investment Company, or we'll call it AFIC. Do you mind stepping us through the performance of AFIC in the last 12 months and focus on not just the total returns of the portfolio of AFIC, but also what's driven those returns from a sector perspective?
Yeah, sure. Thanks for the question, Paul. So on the left-hand side, we've shown the performance of the portfolio against the ASX 200 over various time periods. So we've shown the 1, 3, 5 and 10-year return there. So just looking at the far left-hand side, so really pleasing to be able to deliver performance of 17.8% over the last 12 months versus the ASX 200 at 15.9%. So it's been a really strong period for both us and the market. And that's in the context too of where we've been able to increase the dividend we've paid to shareholders at the recent interim result in February. So the largest contributors to the performance were the likes of James Hardie, Car Group, Reece and Wesfarmers. And these are all companies that had a really challenging 12 months about 2 years ago, and were able to add to our position that price dislocation where they got to levels that we deemed them to be attractive. I guess the interesting thing there is all those companies are ultimately exposed to the consumer. And what we've seen in markets is the consumer so far has held up a lot better than what market expectations have been. So that's sort of been a big driver, and we'll talk to that across the sectors in a minute. So just a reminder that returns for the portfolio were shown after tax and expenses. So if we look at the 5-year return there, which is about 60 basis points ahead of the market, that's after tax. Now, clearly you can't do that for the ASX 200, but in terms of the portfolio, tax and expenses have been a drag of around 60 basis points per annum, and that largely reflects capital gains tax on profits realised through asset sales. And that just drives a reserve or franking credit reserve balance that we're able to tap into in later periods, which we'll talk to in an upcoming slide. So the chart there on the right-hand side just splits market performance over the last 12 months by the various segments of the market. And you'll notice the ASX 200 is a different number on the right-hand side to the left, and that's because the left includes franking to give you the 15.9 versus 14.5. The best performing sectors you can see have been information technologies, had a particularly strong run in recent months, up over 50%, real estate up 36%, and financials driven largely by the banks were up 28% over the last 12 months. I think the thing that really strikes us with this chart is just the large dispersion of returns when you see a 55% dispersion between the best sector being IT and consumer staples down the bottom at -4%. Typically in times like that, it leads to some attractive buying opportunities where the winners have run really hard and the losers have probably been sold off. And we've been able to pick up some companies we'll talk to in a minute at pretty attractive prices as a result of that.
Right, David.
Keep
going. Sorry, David.
No, I was just going to say healthcare is one of those. If you say healthcare, they're down, it was up only 3.3% versus a market up 14%. And we added to CSL and ResMed, which we'll talk to a bit later on.
Terrific. So, David, as a firm, GFM, we're a very strong supporter of investing in high-quality listed investment companies, and we view AFIC as one of the highest quality listed investment companies. And what attracts us to investing in AFIC is this reliable dividend income stream that the company produces. I guess my question is, how do you manage to provide such consistency with your dividends?
Yeah, thanks, Paul. So look, paying a consistent dividend profile or a growing dividend profile is really one of our key investment objectives. And as Mark mentioned, as part of the investment process, we're heavily focused on quality companies. And really, we're looking for companies that can serve both of our investment objectives. So the first of those are primarily there for growth as we try to deliver attractive total returns over the medium to long term. But then we're also focused on quality growth companies that are able to pay us a dividend. And it's not just the attractive dividend at the time we purchase it. It's really those companies that are generating free cash flow that enables them to be able to reinvest in their business to pay a growing dividend profile to look after future dividends for us. So if we look at the chart on the slide here, this just really shows one of the benefits of the LIC structure. What we've shown is the profit performance and the dividend profile of AFIC over the last 5 financial years. And so that's a period where we've been able to maintain the dividend despite a period of volatility in underlying markets. So if we work across from the left-hand side, it just highlights the experience during COVID, where the bars are showing the earnings per share for the AFIC portfolio. So ultimately, these are the dividends that we receive from the companies that we're invested in. And you can see in 2019, our earnings per share was 22.7 cents. And that fell to 16.3% in 2021. So a fall of about 30%, which is consistent with the level of dividend cuts that came through the companies that we're invested into. So at the top of the bars, you can see the line with 24 cents represented across 4 of the years, then increasing to 25. That represents the dividend that we were able to pay during that period of volatility. It was the ability to be able to access our excess franking credits to be able to supplement the dividend during those periods. So a lot of companies were cutting their dividends. We were able to maintain ours through that period. And then as earnings returned to growth in 2023, you've seen us increase that dividend to 25 cents. So as it stands today, our reserve franking credit balance is just under 2 years of dividends. And what that means is if none of the companies we invest into pay us any form of income, we've got 2 years of reserves to be able to pay a franked dividend.
Thanks, David. So before you alluded to a couple of the company holdings in AFIC, I'm keen for you to explain to our clients and guests how the AFIC portfolio is positioned at the moment, particularly in light of the current economic environment. If you wouldn't mind explaining a little bit more about that.
Yeah, it's pretty uncertain times at the moment. So look, we're long-term investors. So every investment we make, we're really taking a 5 to 10 year view, if not even longer than that. We're not trading short-term cycles in markets, trying to trade around the next data point or trying to pick where interest rates are going to go. Really difficult to be able to do that successfully. So what we're trying to do is set a portfolio that can survive over our long-term investment horizon. And we believe it's the quality of the underlying asset base, the quality of the business that will endure over our long-term horizon. And over the 5 to 10 years, companies will go through many different business cycles. Most will go through some form of change in management teams. And it's really the underlying assets that we're ultimately invested into. So if you think about our 2 investment objectives, as I mentioned earlier, one is to pay attractive total returns over the medium term, and the second to be able to pay a growing dividend profile over time. So this chart doesn't tell the full story, but it just gives you an idea of how we set up the portfolio to be able to meet both of those investment objectives. And so if we start on the left-hand side, at the top left there, portfolio has 34% exposure to growth companies. We're really looking for the highest quality growth companies that really are able to reinvest back in their business. They have a market leadership position. They're run by strong management teams and boards, and they maintain strong balance sheets. So these are companies that we think are best positioned to be able to deliver meaningful earnings growth over the long term. And if we move down the left-hand side, you can see the cyclical component there represents a lot of the resources and oil and gas producers. And within that sector, we see they're necessary part of the economy. They're exposed to growing economic growth. So we do want to have some exposure there. But we're very focused on the highest quality operators. So those that are operating at the lowest cost. And even if we start to see commodity prices fall, they're still able to generate a growing cash flow profile. And the right-hand side of the slide really reflects our income objectives. So we've got stalwart companies that own really difficult to replicate assets. There's high barriers to entry. They're market leaders, so the likes of Woolworths, Coles, Transurban, ASX, for example. And then our income objective comes from those in the bottom right-hand corner, which reflects largely the banks, some of the REITs as well, and Telstra. And so all of these companies we think are well positioned to deliver a growing dividend profile that enables us to meet that second objective I spoke about earlier.
Great. You spoke before about the uncertainty, or you mentioned the uncertainty of the economic environment, but I'm keen to understand at a corporate level how you viewed Australia's last earnings reporting season and whether there are any themes that you saw emerging out of that reporting season.
Yeah, sure. So look, it was really probably a reporting season where we went into it, or the market went into it, thinking that things were probably going to be worse than what actually materialises. So things were slightly better than expected. And if we think about the key themes that came out, we did see some signs of revenue growth slowing, and the companies have had a pretty good run sort of in that post-COVID era where they've been able to pass through rising cost onto their end customers. And a lot of consumers have had government handouts just supporting their spending habits. So we're now seeing signs that revenue growth is slowing. However, during Feb, we saw a lot of companies were able to reduce their cost just to be able to grow their earnings through that means. And we saw that price was quite a big lever. Going forward, I think we're slightly more cautious than that. It's our view that earnings growth is going to be slightly harder to come by. We think the sustainability of pulling the price lever is going to become more challenging. And there are early signs that the consumer now is starting to feel the pinch around the cost of living. So our view is that earnings will continue to grow across most sectors of the economy, but at a slower rate than what we saw from the recent reporting season. So I guess we're slightly more cautious on the ability for companies to be able to deliver meaningful earnings growth from here.
And David, the million-dollar question is, obviously markets have had, broadly speaking, if you've been an investor in the Australian share market over the last 12 months, returns have been strong. So after this strong price appreciation that we've seen, particularly in the last 6 months, how are you viewing valuations in the Australian share market?
Yeah, thanks, Paul. It's a good point, and one that we always sort of come back to just to get a sense of where things are now trading. And these two charts here sort of showing the price to book and the price to sales for the ASX 200. And you can sort of see towards the right-hand side of both charts just the strong running markets that we've had since the end of October. And at the time, the Fed out of the US had come out and said they're likely to be, the next move in interest rates is likely to be lower. There were 5 or 6 interest rate cuts being priced into markets at the time, and you saw equity markets rally quite sharply out of that. We're now at a point where the expectations are for 1 to 2 interest rate cuts. So we're not trying to predict that, but these are sort of good measures to give us a sense for where valuation is at the moment. And on both measures, as shown on the chart here, both are trading slightly above sort of long-term averages. And in the context, as I mentioned on the last slide, with earnings growth being a bit harder to come by, we're more discerning on where we're deploying capital in the current market. And while you always want to be really cautious that you're investing where you see value, that's particularly important at the moment where you see where valuations are relative to sort of their long-term history. But in that regard, we've made a couple of recent changes to the portfolio. We've been able to trim some companies that have run really hard for us and been really strong performers. So that's the likes of James Hardie, Reece, CBA when it got up around $120, and even Woolworths within the last 3 months, where we took some capital out of Woolworths. And it's really buying driven. So we're looking to where we put that money really drives that decision making. And most of the investment has gone into existing holdings in the portfolio. So as I mentioned earlier, we're able to buy some more ResMed or add to our position. We just felt that the threat from obesity drugs has been overplayed. Share price had fallen over 30%. And we know that sleep apnea, which is the disease that ResMed is treating, remains heavily underpenetrated. Only about 10% of people that require treatment are actually currently getting it. So for those reasons, we think both ResMed's products as well as the GLP-1 drugs can coexist. And we still think ResMed's set to deliver meaningful earnings growth over the long term. We added to CSL when it fell quite sharply last year, and CSL's had a tough period during COVID where donors weren't able to get into collection centres. In order to try to stimulate that demand, CSL increased the fees that they were paying to donors, and that's led to quite a hit in their margins throughout that COVID period. So we think they're through the worst of that now. We think the company is really well positioned to be able to deliver strong earnings growth over the medium term, and for everything we can see, that demand for plasma products remains really, really strong, and that the therapies that CSL produce, we expect them to be able to sell that through with a higher margin profile. We've added to Telstra in recent times. We see the companies continuing to put through CPI price increases. The majority of earnings is now coming from their mobile business. And together with the cost out strategy that they've got in place, we see Telstra set for a period of meaningful earnings growth over the next few years, and we're getting a fully franked dividend yield of near 5% on the way through. And the other one that we've recently added to is Woodside, which has seen a sharp fall in the share price now down to where levels we deem it to be attractive, around $30. And our thinking there is that the long-term historic oil price is around $65 a barrel. It's much harder to bring supply to the market these days than what it's been historically. We've seen demand hold up pretty consistently with what it has been over the last 5 to 10 years. And with the challenge of bringing supply to market, we see the underlying environment being supportive of a higher price going forward than what it's been historically. And with Woodside having merged with BHP Petroleum, the balance sheet's now in much better shape. We rate the management team really highly. We see the business set to deliver significant cash flow growth, and that should flow through to higher dividends for shareholders. The only other two additions to the portfolio were Ampol and Region Group. So Ampol owns the convenience service station network and also is one of two oil refiners in Australia. So oil refiners have now become much scarce, really difficult to open a new one. And Ampol is now being supported by government stimulus efforts to try to keep them in operation. So we see the cash flow from the refining business improving. And what management has done here is just to exit a number of poorer performing, lower quality sites in their store network and really focus on a more concentrated site network, which are a better position enabled just to deliver stronger earnings growth going forward. And the second one, Region Group owns a REIT, which owns a portfolio of neighbourhood shopping centres. So I think the likes of Coles and Woolies and about 15 to 20 specialty shops, really stable, non-discretionary income. And the purchase price, we're able to pick this up, represented an attractive dividend yield of around 6.5% with some earnings growth coming through.
Terrific. Thanks for that update, David. Really appreciate it. So we're going to now shift focus to Mirrabooka. And Kieran, I'm going to hand over to you. So first and foremost, Kieran, do you mind just talking to us about the difference of investing in Mirrabooka to AFIC?
Yeah, sure, Paul. Look, I guess the most obvious difference we think comes through pretty well in this slide, which is the point that in investing in mid and small cap companies, Mirrabooka gives our investors exposure to very different companies than they'd get in an AFIC or a broader ASX 200 backed portfolio. What isn't different is the investment approach that we take. So the sort of introduction that Mark gave, talking about the quality first of the companies and the long-term horizon we take, we apply that framework to investing in this end of the market. We think that's important for people to really realise that. There's not speculation going on here. This is genuine fundamental investing in good quality companies in a different end of the market. You see that on the slide here. We sort of take great pride in these orange bars that we show. We think it's a real differentiator in this end of the market, that we are long-term investors. We do back up what we say on the label. And we think that's important because if you are investing for the long term, you can't avoid that sort of growth and quality approach. If you're not looking for those companies, you won't win in the long run by putting them in the portfolio. The reason we think this sort of area in the market can be interesting, there's sort of three factors that we think can drive superior long-term returns, investing in small and mid-sized companies. The first being you can get more of your money alongside the founders of these businesses. And we find that when we do that, you get the combined benefit of their passion. It's their life's work. They work harder. They often don't pay themselves as much. But they also make really rational long-term decisions with their capital because they work very hard to achieve what they have. The other two factors we think that help with that long-term return is the fact that you can get into companies at an earlier stage in their growth profile. So you get to own them for more years when they're delivering really high rates of earnings growth before they start to mature. And in doing so, if we're hunting well, we can find these companies, we can discover them before other people. So you get a valuation benefit from that. You pick them up and then others recognise what you did later on. So that's the theory, and we'll touch on performance on subsequent slides, but the track record backing this has been really good. So as Mark mentioned earlier, what we've been able to do is have a really consistent run of getting realised gains out of the holdings in the portfolio as they either get taken over or we take parts out of those holdings. And that's enabled us to generate a franking stream that's meant that we've been able to give shareholders the best of both worlds. So the good, superior long-term capital growth, but also a really reliable, attractive dividend stream along the way.
Thanks, Kieran. I'm going to go a little bit off script here, but on this slide, one thing that jumps out at me is the ownership period of these companies. So investing in the mid and particularly the small cap part of the market, I guess there's probably a general feeling out there that there's a necessity or a need to trade, but I look at this ownership period here and the number of years that you've owned these companies. Do you mind talking us through why you end up being such loyal investors in these companies?
Yeah, look, I think that I think the point I'd make about this is it's a bit of humility, really. I think there's a lot of people in the market who think the fund manager thinks they're creating the value, that they're sort of smarter than the market and they can pick when things are going to go up and down. You've got to be really good to do that. So what we've been able to recognise is our job is actually to allocate the capital to outstanding businesses and then not get in their way. I mean, you obviously got to question them, see that they're still on track, but they're the people that create the value. And if we select them well, the businesses will do the work for us. It's then up to us to recognise the cycles, and when you do trade around that a little bit, you take some out when they've run too hard and you buy them aggressively when they're oversold. So these positions don't sit static for that period of time, but it's important to recognise where the real value is being created, and that's the people running these businesses.
Love that humility approach, Kieran. So look, I guess the next question is around the recent performance of Mirrabooka, which you alluded to before, has been very strong. Can you step me through the recent performance of the company and how you've achieved these returns, and give us a little bit of an update on some of the company holdings?
Yeah, sure, Paul. Look, we often try and sidestep this question a little bit, so I'll come back to it. I won't avoid it, but we really want to emphasise the fact that we're here to try and optimise those 5 and 10 year numbers. And I think in doing that and investing in that way, that's, we've delivered a really good track record of doing so. So if you look back at sort of any of our month-end numbers, those 5 and 10 year bars have had an attractive gap between our return and the market. We think it's important to focus that way, because you do get those better returns. And what it can mean is we can have a bit more volatility with our 1 year number relative to the market than you might see in an AFIC. And it's been interesting, actually, since COVID, we've had more volatility than we had before in that. So it's been a strong run. You see sort of that 3 year number captures it. We've outperformed the market over that 3 year period. But if I sort of take you back, we had a spectacularly good 2021. It probably ran a bit too hard. And into 2022, we sort of had a bit of a normalisation of that. So that was a more painful year than we normally experience. But we think in that year, then things got oversold. And we'll see on the next slide. This is just a selection of some of our core holdings that really, that 38% average fall in their share prices in 2022, and then the subsequent 89% average rally in 2023 through to February 2024. We've sort of been saying to people, you'd be hard pressed to explain why this is the case if you sat in our meetings with the management of these companies, heard the questions we're asking, the answers we're giving, the way they're running the business, the sort of true fundamental value they're creating. There's no way it's been as volatile as this, but this is the equity market. Sentiment swings valuations in both directions. It's been a bit more of a wild ride than usual, but coming through that, the portfolio is in really good shape, and the companies we think are, delivering, to expectations and beyond, which is the most important point. I'd probably take you back also, Paul, just 2 slides back to the top 20. There's probably 2 companies to mention on this slide. To get into our top 20, you'll see normally you have to earn your way in there over a significant period of time. You have to generate good returns, and and that position builds up as the company's winning. There's a couple there, Gentrack and IPD Group. Gentrack's got there within 1.5 years, and it's now the 6th largest holding, and IPD Group within 2 years. These are cases where these share prices are up 4-fold since we bought them, in both cases in 1.5 and 2 years. We don't always do that, of course, but it does show you the ability to really, it's that discovery piece, find something before others sort of pile in behind you and get attracted to the same thing. And that's also been a key feature of that recent, really good performance we've delivered.
So some serious pearls of wisdom in that answer, Kieran, around being a market investor and market participation. I'm going to ask you to look forward. I'm keen to hear about, about your outlook for the Mirrabooka portfolio as it stands at the moment.
Yeah, sure, Paul. So look, we're very aware of the cycle, that volatility we described with the short-term returns we get in Mirrabooka. We're aware that we've had a really good run in our portfolio of late. So if you look to the bottom of this slide and the sort of companies we've trimmed, a number of these are positions that were quite meaningful and still are quite meaningful, top 20 holdings. We're not selling out of them. We still think they're great companies, but we're very aware of the valuation and the run they've had. So I guess the good news in that is, in terms of outlook, that creates, we have to pay the tax, but it creates franking credits. We've already got 3 years worth of franking credits in reserve to support our ordinary dividends. This again supplements that, which is, we think, gives a really good solid outlook for our dividends to our shareholders. But we think in total return terms, after the run we've had, it's natural to think that, it's probably going to be a more measured period. It may even see some underperformance in the short term, given that run. In terms of where we've been investing, I guess we've been trying to find some new names for the portfolio. Absolutely hell-bent on saying they've got to be good quality. The last thing you want to do is to buy better value, but you're actually just trading down in the quality in the portfolio. So that's the first thing we ask ourselves. But just looking around and saying, where is relative value in some still really good quality businesses? And maybe some of these businesses don't quite have the spectacular growth outlook for the long run. So we've probably just taken a little bit of money out of the higher growth companies where the valuations are higher and just found better relative value in good quality companies elsewhere. I won't go through those companies we've been buying in detail. If I get started, I'll go through all of your time and everyone else's. I'm pretty passionate about this area of the market, but that's been the sort of broad theme of how we're investing and seeing the outlook.
We love the passion, Kieran. Okay, so Brett, I'm now going to switch gears and we're going to focus on Djerriwarrh, or Mark called Jerry. The objective of Djerriwarrh is to provide investors with an enhanced fully franked yield in excess of the ASX 200 using options plus long-term capital growth. So I'm really keen for you to talk us through the process of using options to enhance the yield and hopefully the performance of this listed investment company.
Yep, will do. Happy to. Thanks, Paul, and thanks, Kieran, for leaving us some time to talk about Djerri. So just to restate the objectives and the approach first, just to manage the options book. So Djerriwarrh is our income company. So the primary objective is to deliver a dividend yield that is above the dividend yield of the share market. That's what we call our enhanced yield, but we want to deliver an attractive total return over time. So a balance of income and growth. But the way we generate the income is two sources. There's the dividend income and also the dividend income involves us constructing a portfolio, very low turnover, and it's quite a similar portfolio to AFIC. The option income is what really sets Djerri apart and makes it quite a unique product in the market, and it's the key driver of the through that a little bit. So how do we generate option income? So we are a seller of options across stocks that we hold in the portfolio. We predominantly sell call options, but also put options in some selective cases. And the way we generate the income, it's turned out to be quite a reliable, but also a much more consistent level of generating income than some might believe. So if we just look at the last 3 financial years, the dollars amount of income that we've generated from our option strategies have been 12.1 million, 12.5 million, and 14.8 million in the last financial year. So we are a seller of options. We are not using options to speculate or hedge. We're only using an option strategy to generate the additional income. Now, as anyone who has studied economics or markets would know, there's no such thing as a free lunch. So it sounds good to sell options to get paid premium income, which you use to boost your yield, but there has to be a cost to that. And the cost is potential future capital growth. So essentially, it's a trade-off between income today and growth in the future. That's the trade-off that we're managing. Naturally, you can't have both to the full extent. But what we think we can do is find that sweet spot of generating enough extra income today without really hurting the capital growth in the future. And that's something that we're very confident that we've got the right portfolio strategy, but also settings to do with our approach in how we sell the options. And we can sort of see some of the results of this. So for the most recent month, the enhanced yield for Djerriwarrh has been 1.5 percentage points above the market. So a dividend yield of 6.3 versus the market of 4.8, both grossed up for franking credits. And then in the most recent year, Djerriwarrh's total return, which is the light blue bar on the right-hand chart, has been above the market, which is the green bar there. So extra income, but also a compelling and attractive total return as well.
That income is certainly welcomed by our clients, Brett. How important is the active management of options and probably specifically referencing in a difficult market?
Yeah, it's a really important point. It's that the active management of the options book is a crucial part of the strategy. So whilst the stock portfolio to generate the dividend income can be quite set and forget and almost with a buy and hold mentality that focus on quality long-term investing, the options component is very different. It requires both strategic positioning, but also tactical positioning too. And so what I mean by strategic positioning of the options book, we really need to have the settings right, that we're writing enough options to generate that required level of option income. But on the tactical side, we need to be very reactive to what's happening in the market, because there's a lot of tactical moves we can do in response to share price moves, across the whole market, across sectors, but also across stocks. And it needs to be done on a daily basis, because there's a lot of different tactical moves you can employ in the options portfolio. It could be writing calls or puts. It could be writing new positions. It could be closing existing positions if they've done well, and we can do that early, or it could be rolling positions. So there's a lot of scope for active management. So you really need to be doing it on a daily basis. And then but you need a couple of other components as well. One, you need a balance sheet behind you to do it, because with the options book, you have cash inflows and cash outflows, and you need a balance sheet with debt facilities to be able to manage those cash inflows and outflows. So that's why we do it in this product here, being it's a standalone listed investment company that has its own debt facilities that we can utilize to manage those cash inflows and outflows of the options book. The other one is that you need the expertise in the options market, and it's definitely not just one or two people. We've got a dedicated dealer who's been trading options for, I think, coming up to 20 years, and Djerriwarrh itself has been going for more than 30 years. So it's got a long-term track record of operating in the options market, which has changed quite a bit over time. And we really need to use all those components to manage it on that daily basis. So the options bit is definitely not a set and forget strategy. It needs to be actively managed.
Terrific. Now, while the options are obviously a very important feature in Djerriwarrh, of course, the core of the company is owning a high quality portfolio of ASX companies. Do you mind giving us a little bit of an update on the portfolio holdings within Djerriwarrh?
Yep, certainly will do, Paul. So the slide in front of us shows the top 20 holdings on the right-hand side, BHP being the biggest holding in the portfolio, followed by CSL, Transurban, Macquarie, and so on. So hopefully this gives a snapshot of what I was talking about with the portfolio construction, focus on high quality blue chip names. And ideally, we want to hold these companies for the long term. And that's the similarity to AFIC in the way that the portfolio is constructed by stock names. Now, our weights within these companies will change over time, and that's the impact of the option strategy. So getting back to the cost of writing options, so the benefit, you get the income, but the cost is you might have to sell if you get what's called exercised on your call option. And so we'll be a forced seller of stock. And that's been happening a lot lately in a strong market. That's what we typically expect employing this type of strategy. So whilst we've generated some really strong option income in the financial year to date, we've been sellers on the other side through option exercises of stocks that have performed really well. And some of the key ones there have been the banks. So we were big buyers of the banks a year and a bit ago. The share prices have performed extremely well. And so lately, we've been exercised on some of our call option positions in the banks, which means we own less of those today, in particular NAB, Westpac and Commonwealth, but also other industrial companies such as Wesfarmers. And a name that used to be in our top 20, we still hold it, but it's not in the top 20 today, is JB Hi-Fi. Again, performed extremely well, and we've been exercised on some of the call options there today. So overall, the portfolio, these are the stats at the end of March, 47 companies, just under $900 million portfolio value, and it all added up to a net tangible asset backing of $3.38 at the end of March. A feature of Djerriwarrh at the moment is whilst the dividend yield is very strong, as we saw earlier, that 6.3%, that's on $3.38 net tangible asset backing per share. The shares are currently trading at a discount to that net tangible asset backing. So the dividend yield on the actual share price, if you're buying today, is greater than 6.3%. It's actually more like 7%. So good dividend yield. The growth's been good as well over the last year. So that balance between the income and growth has been, we think, has been quite good. One extra point I really want to highlight on the dividend that we've paid out is the sustainability of it. That, to us, that's just as important as the dividend yield today. The dividend needs to be sustainable for the future. And there's two key points we'd highlight there. That our dividend is fully covered by the net operating profit per share. It hasn't been boosted by one-off realised capital gains, which we could pay out in the future, but we haven't been doing that even to generate a strong dividend yield today. So there's that. And Djerriwarrh, like the other investment companies that we've talked about, also has good cover of franking credit reserves. So both of those, we think, points to sustainability of the dividend. Just a really quick update on the portfolio, how we're positioned, so we can see the holdings and the key metrics. We're quite defensively positioned at the moment. So a lot of those option exercises and forced selling of stock that's taken place, we haven't reinvested at all. We're holding quite a bit of cash, waiting till we see better value in the market. We've been nibbling away at some stocks, such as Woolworths, Telstra, Transurban, Newmont, and Coles, but it's been very selective. Largely, we're holding a lot of cash until we see better value in the market. So what it does, it gives Djerriwarrh a positioning of having, good progress on our option and dividend income year to date, but we've also got quite a bit of firepower, for want of a better word, if we see good value in the market, to invest some of those proceeds back in, set the portfolio up from here.
Thanks for that, Brett. I'm really glad that you touched on the sustainability of the dividends within Djerri as well. That was going to be my next question, which you covered really well. So, Mark, I'm going to loop back to you. Brett just touched on this briefly, but one of the characteristics that's become obvious to us of recent times is the fact that, particularly in the instance of AFIC and Djerriwarrh, that both of these companies are trading at a discount to their net asset backing. And particularly in the instance of Australian Foundation Investment Company, this is something that happens less often than, in fact, when it more often trades at a premium. So I'm keen to get your view on these companies trading at a discount and what that means for investors and potentially the opportunity for investors.
Okay, thanks, Paul. So, I mean, as you can see, the top left chart is the AFIC one, and it does have periods where it can trade at a small discount, and there's often different reasons for that. Usually when markets are a bit hot, we tend to get left behind a little bit because, at the margin, people are seeing opportunities themselves. And I think that's been an environment we've been in where there's been, I guess there's a lot of hot stocks are running hard and we get left behind a little bit. I think there's been an element also across retail investing. Certainly the feedback we get is, at the margin, there's less money going into equities from retail because you can now get good returns from fixed interest. That asset class didn't really exist probably for the last decade until interest rates went up. And so I think there's a lot of money in retail land where people are saying, actually, I'm happy to get returns out of bank or term deposits, and that takes a bit of buying. So that with a hot market. And also, I think there's been a few issues with, again, over the last 5 to 10 years, a lot of new, what we call new LICs have come to the market, and some of them have really struggled. And I think it's left a bad taste in some investors' mouths, particularly where there's been poor performance. And they're typically, the new ones charge high fees, high performance fees. They're subscale. And I think it has dragged the whole sector down a little bit. So I think there's probably 3 elements that are sort of creating a bit of weakness in the NTAs. But, the feedback we get from some who watch it closely, that presents opportunities. So that's for everyone to decide. And yeah, likewise with Djerri in terms, that surprised me a bit at the moment because, the performance that Brett and the team have delivered there on not just the yield and the total returns and getting a yield that's sustainable, getting good total returns, that really looks quite attractive in terms of that relationship with NTA. Mirrabooka is actually trading around NTA, and then AMCIL's actually traded at quite a bit of a discount, although that's closed a little bit more recently. That's still at a bit of a discount as well, because that's our smallest LIC.
Well, I'm happy to say, Mark, that I think it does create an opportunity to be able to buy assets at a discount to their real value. Now, of course, we'll finish off with the fact that while we've very much focused on AFIC, Djerriwarrh and Mirrabooka in the stable of listed investment companies that the team manages, you also have AMCIL. And while we're not an investor in AMCIL, we've certainly admired and kept a very close eye on the company. So do you mind just spending a couple of minutes explaining perhaps the key differences of AMCIL to the three other listed investment companies? One that I understand is potentially the opportunity to buy global companies.
Well, so AMCIL's what we call our higher conviction fund, and you can see the performance numbers again. These are also after tax, and it's like all four of our LICs out. We only show the performance to the extent we've actually paid out franking, but in each case we actually haven't paid out all the franking. So there's performance that's still sitting within the funds that doesn't get reflected in these numbers. So all our numbers that we've showed you today are kind of understating the performance. And likewise with AMCIL, we've got franking credits sitting there that we haven't paid out. Really, the purpose of AMCIL is really to try and pick the eyes out of the large, mid, and small cap. With it, I call it about trying to be pure to our process. Stick really with the highest quality companies. Be very opportunistic when you get little dips. AMCIL is our smallest fund, and it's got the portfolio there. And just to, I guess, highlight, we are sticking really with the super high quality. And whenever we see a price dislocation event occur, Dave touched on, the sell-off in healthcare stocks last year. There's always something, as I said earlier, there's something that caused weakness, and we try and grab those opportunities in AMCIL. So AMCIL's about 380 million, and it's something we don't have any international at the moment, but just the background to that, for those that don't know, we've actually been running an international portfolio in-house. That's held within the AFIC portfolio. So about 1 to 1.5% of AFIC's fund is actually in a portfolio of very high quality international stocks. That's created value for the portfolio, and we're looking at actually potentially producing an LIC out of that. And we're going through the process now, and like we've done with the other companies, we want to do it in a cost-effective way, low turnover, tax aware, low fees, no performance fees, the typical structure. And so we're working our way through that, and it just means that there's potential then to draw on that skill base in AMCIL at some point and say, well, if we can find a couple of good international stocks, we'd certainly be open to that in AMCIL. Which would then sort of create more differentiation of what AMCIL is against the other LICs.
Thanks, Mark. So we're out of time now. So I just want to say, Mark, Brett, Kieran, David, thank you. On behalf of our GFM clients that are investors in these companies, we're very appreciative for your expertise and your prudence around the way you run these companies on behalf of our clients. And more importantly, thank you for sharing your observations on each of these companies today. It is genuinely appreciated.
Thanks, Paul.
Thanks, Paul.